Hi there, and welcome to another edition of the Premier Investments in Wealth Management Financial Program. My name's Doug Wagner, your host, and before I introduce the three gentlemen around the table with me, I want to remind you that you probably don't know what your retirement is worth. In fact, you probably may not know when you're going to retire, how you're going to retire. If you're like most Americans, these questions are just still up in the air to you, no matter what your age. Here's an opportunity for you to get that under control. Go to premieriwm.com, click Get Started, and just answer a few questions. From there, you'll be provided a one-page Premier Vision document and an opportunity to sit down and meet with one of my friends from Premier Investments in Wealth Management. They'll walk you through what they do on a daily basis, and that's answer your retirement questions so you can find out if you're ready to retire and what that might look like. premieriwm.com. You can make that appointment online as well. It's calling 800-383-6590. Now, in the middle of the pack over here, a wealth advisor with over 30 years of experience in the investment industry. It's Jonas Everett. How you doing, Jonas?
Great, Doug. Nice hat.
Thank you. Golf hat. The Premier
awesome.
Investments.
You look great.
In fact, I'm all PWIM'd up. So.
Hey, you got more swag than any of us.
I I'm just trying to figure out how you got it here instead of on the sleeve.
That I don't know. You don't want to see my underwear. Right next to me, wealth advisor, accredited investment fiduciary, certified financial planner, professional. He's got over 10 years of experience in the investment industry. He is Dr. Casey Mushrush.
Just see you, Doug.
Casey, how are you?
Good.
Good to see you at the neighborhood.
It was good to see you at the neighborhood get together.
That was fun.
I don't know if, I guess you weren't around, but our cat joined us later on.
Oh, really?
We actually had one of the cats show up.
Nice. That's good. Well, I was officially invited to the Catter Day, which is coming up next year, so I'm looking forward to this. Also here around the table, president and wealth advisor, accredited investment fiduciary with over 22 years of experience in the investment industry. He's got more great uses than a package of albacore tuna. His name is Roger Abel, and he is the big kahuna.
Thanks, Doug. Good to see you again.
Brought the rhyme with me today.
I do like the swag you have on your
Thank you.
On your head there.
Well, I appreciate it. I got the whole Premier Investments and Wealth Management thing right here. And you know what? We just finished up with Labor Day, and so we're winding summer down unofficially, and we're moving toward the rest of the year, especially fall, and getting ready for football time of year and things like that. So we thought that we would start off here real quick by, if you want to become a self-made millionaire, there's well, I don't know about an easy way being one, but you can start with Jonas's money tip of the week. Jonas?
Yeah, I thought that this was really interesting, and I golf with a couple of guys that, you golf, Doug, for people for 4.5 hours. They're bound to talk about work every once in a while.
Yeah.
And I was in a business class for a couple of years. I drove back and forth to Chicago about 8 times. Mm-hmm. And they recently had a study, which was a survey of their customers, and they have a special part of the class that are higher net worth customers. And I thought that this was really interesting, and I'll kind of throw it over to you guys. But all they had was a survey to their high net worth customers that said blank equals money. And they had a multiple choice A, B, C, D. And what do you think they answered, Doug? So A was investing, B was hard work, C was good luck equals money, or D was relationships.
I'm going to think A, simply because it's investing and me really.
You would think like a business class investing, you know, like we talk about all the time. You know, you start $25 a month and then you raise it.
It takes money to make money.
Max out your 401k. Actually, these high net worth individuals selected D. They said relationships equal money. And the reason I thought about this is I golf with a couple of buddies. One has been at his new job for 28 weeks, manufacturing job. Mm-hmm. The other one has been at his job 28 years. And the difference between their opinions of their bosses and who they work with is just amazing. So the one that's been there 28 weeks, he has such a good relationship with his boss. Mm-hmm. He was able to meet the man in charge of the entire company within 28 weeks. And he was given some stock options just for being a delight to work with for everybody, just being good at his job and having some good relationships. The other one that was at a manufacturing company for 28 years, he thinks all his managers and bosses are out to get him. So we talk for a while. Oh, they're out to get me. They see me coming when I go sign up for my paid time off. And so just a kind of I thought that was kind of a neat way for people to kind of remember that when you're thinking about financial success, think about who you should be building relationships with.
It brings me to something that I saw on the Premier Investments and Wealth Management Facebook feed that you highlighted Chris McNeil out of your Dallas-Fort Worth office recently. He was working with a group that was serving meals or serving the community in a philanthropic organization. It's kind of important that people, they become involved with things like that because otherwise you can become really insular, can't you?
Yeah, that for sure that happens. And honestly, Chris is one of our best advisors of growing relationships and doing a lot of that community outreach. But as you're reading this, Jonas, it makes me think of the old adage, it's not what you know, it's who you know. And it really is true because you never know when you're one relationship away from some life-changing event or getting the opportunity that you wouldn't have had if you didn't have those relationships. And then you start to think about the people who've been ultra successful throughout their life, and they share a couple things in common. They're laser focused. They manage their time, but they're great at building relationships.
Yeah. And Casey, there's something as well. It's not what you know, it's who you know, not in a negative way, because a lot of times we have a tendency to, they know that person, so they've got an in there. It's about maybe the quality of the relationships that you have, not necessarily how high they are on the
Well, I think too that again, and obviously we don't have access to the direct survey results as far as that went over on there, but I look at that also as a way to leverage time. Because I'm surprised that actually wasn't on there, or at least as far as an option, that time wasn't one of the answers where time equals money. Right. And I think that that's definitely a true thing as well. But even over on those relationships, being able to recapture that time, being able to recapture and focus on those things, to your point, Roger, doing the things that are actually really important, that allows for a much higher degree of success. And that doesn't necessarily translate only monetarily, but also goes into satisfaction of life in general. And I think that that's an important piece of it too.
You made a good point though, Doug, that it's not how high in the totem pole they are.
Right.
And, I think in our business, we get referrals from people quite a bit. And we could have a customer who maybe doesn't have the biggest account, but our first 15 people a year, that's a great customer. It's not necessarily about how much money somebody has, because there's other ways that we, generate revenue and keep the business going. Right. But that's just like in life in general. It doesn't have to be the wealthiest person that could take you to where you want to go. They just have to connect you to the right people along the way.
Right. Premier Investments in Wealth Management, you'll find that it's more than just about investing in money. It's about the relationship building that they do with you and around you, really. It's something that's very important for you to get an understanding of. PremierIWM.com. Premier Investments in Wealth Management is named to the Forbes 2025 Best in State Wealth Management Teams. Get in touch with them today at 800-383-6590 or make that appointment online at PremierIWM.com. Casey, I'm going to turn to you. We're going to start with listener questions. Amanda asks, I'm self-employed and contribute to a SEP-IRA. More about that in a second. But I've heard that there are better options for higher income business owners. Should I switch to something else? First of all, what is a SEP-IRA?
Yeah, so the Simplified Employee Pension IRA or Simplified Employee Pension Program, basically it's a retirement plan that is sponsored by an employer. Okay, so it's an employer-sponsored plan, and it allows a deferral into that based off of a percentage of income. So the maximum actually that you can do in 2025 is $69,000 over into this. It actually just changed here relatively recently. We used to not be able to do Roth contributions in there. There can actually put Roth contributions into those SEP plans with some various different limitations on them. But it's essentially a percentage of income deferred into that plan at a maximum of 25% of that compensation. So, just in doing some really quick math on there, I mean, you're talking over $200,000 of income for a business if you're trying to do a 25% with that $69,000 max deferral in that particular instance.
Well, and it's not $200,000 of income; it's $200,000 of profit.
Right, profit income.
People get caught up there, and that's one of the disadvantages to a SEP is if you're like most businesses where you have $200,000 of income, you likely have $100,000 to $200,000 expenses if you're running a normal profit margin. Well, the 25% is based off of your net profit, not off of your gross income. Okay. So I think that's something to distinguish. And one of the things that we see people gravitate towards too, because of the flexibility, especially in the self-employed world, is setting up a solo 401k.
Right.
And that's really just establishing your own 401k. If you're paying yourself a salary, you can do 100% of your salary up to the applicable IRS limits. It allows for loans. It also allows you to put in what's called a discretionary profit sharing for yourself. And it's just a significantly better way for most employees.
Well, what's kind of interesting on that 401k is you can still do the 25% profit share.
Yeah.
It's just discretionary at that point,
plus
right?
100% of your income.
Right.
So if you pay yourself a, $23,500 salary, you could put all of that into 401k and still do 25% into the profit sharing.
Yep.
So you can get a lot more money in, gives more flexibility. And really the only downside of that solo 401k is if you get I think it's 250,000, then you have to start filing the Form 5500.
You got a 5500 easy.
So you probably are going to get a TPA involved. There might be a little bit of extra cost, but if you're socking away $60,000 a year, I don't think you're worried about the minimal cost of a third-party administrator.
Well, and it depends on the TPAs too, because there's some that they do the Form 5500 EZ, they do a little bit of compliance reporting and some stuff like that, but it's not like in like a traditional 401k plan. Right. So one of the issues or one of the challenges with a standard 401k plan is you might have to do top heavy testing. So if you've got an employer and like 3 employees or something like that, and that employer is paying themselves a much higher wage and they're making major contributions to that plan, and it suddenly becomes top heavy, now there's some IRS testing to say, hang on a second, this really is an employee benefit. This is an employer benefit for yourself that you actually created over on there. Now, there's some ways to get around that with safe harbor matches and some safe harbor contributions and some things of that nature. But, that's definitely one of those things that there is a lot more flexibility within that 401k format just based off the contribution limits that you're mentioning.
Who wants to talk to me about defined benefit plans, because that may offer something, and see, this is one of the options down here and how it offers maybe a little bit more flexibility as far as the size of contribution? Not all at once.
Well, we're talking about traditional pension plans.
Yeah.
And they're just not as popular as the what they call the defined contribution or the 401k plans.
Okay.
And you can tell just by the percentages of businesses. I think it's down like 89% of businesses. There's only maybe statewide. The states offer. They're popular in states, these defined benefit plans, but they're for a business to start them very complex.
Okay.
Well, and there is another, so like a cash balance plan, defined benefit cash balance plan, which allows like extremely large deferrals, and essentially, you can defer it's like $2 million over into one of those plans over a set period of time. However, there's always the however. The makeup of the plan. So it will be. There will be some discrimination rules that are over within there. It has to be, take, for example, somebody who is a young employer that is maybe employing people who are a little bit more seasoned than them. They still might be making major contributions for those people because of the differences over in those ages. So there's some actuarial considerations in putting those cash balance plans into place that it isn't necessarily a good fit for everybody.
Amanda, this is why it's important for you to consult with a professional with regard to this, because there are lots of different things that make up if your company matters, and there are a lot of other factors that matter as well. So get in touch with your professionals at Premier Investments and Wealth Management. PremierIWM.com is the website. If you go there, you can answer a few questions, and you can be provided a one-page Premier Vision document, and they'll sit down and go over it with you in a free, no-obligation consultation. Now, maybe it's not going to work for the business that you have, but it gets you in the door. So at least you have that relationship, which we talked about earlier, that you can benefit from. PremierIWM.com. Make your appointment online, or you can call 800-383-6590. Premier Investments and Wealth Management named to Forbes 2025 Best in State Wealth Management Team. All right, let's see. I'm going to go to you, Jonas. We're in our 60s. We want to gift money to our grandchildren now, not when we're gone. What's the smartest way to do that without triggering tax issues or reducing our own retirement, Jonas Everett?
Well, I think there's definitely some options. It definitely starts with a financial plan to make sure that Diana's retirement, and if she's married, the spouse's retirement is covered. Because I'm looking at this in the 60s. There still might be another 30 years of retirement. And we were talking about inflation off air. And I would say start with a financial plan. But yes, you could do up to $19,000 without filing any gift tax returns, and that includes the husband and wife, so up to $38,000 per child. But I would want to do the financial plan to, me, Doug, look at the spare tires, look at the emergency fund, make sure that they're financially successful before they start doing this. I love the idea of giving while you're alive and you're able to see your beneficiaries and your heirs enjoy it. But I think it has to be done. The math has to pencil out.
Right. It has to. 529s, college saving plans are one of the most popular ones, and it's everywhere. It's ubiquitous, Roger.
Especially for grandparents. Mm-hmm. It's a really great way. We played a little, not a trick per se, on the grandparents, but when it comes time for holidays and birthdays, typically you give kids give them presents or toys or whatever it is, and what happens to that toy? It's at Goodwill in about 6 months, or they don't play with it. Sometimes it's 6 hours.
Yeah.
But most 529s have the option where you can get a little code and make a direct contribution to a grandchild's 529.
Okay.
So we always send that to the grandparents at Christmas time for them to make gifts in there. Now, obviously, they can make larger gifts into that 529. And due to some changes in the 529, it's become a lot more liberal in how the funds can be used. In fact, I used to hear a lot that, well, I don't want to do a 529 because if they don't go to college, I don't want to have to pay taxes and penalties. So I first want to get out of the way. What is taxed and penalized? It is only the earnings. So if you put in $50,000 into a 529 plan and it's worth $60,000 and you just cash it out, you pay tax and penalty on $10,000. That's it. So first off, taxes and penalties should not be a reason why you don't do a 529. But secondly, with new legislation, you now can convert up to $35,000 for that beneficiary to a Roth IRA. So even if they don't use this for college and they have $35,000 left, you can convert that to a Roth.
And that's federal legislation?
Yeah, that was Secure Act 2.0.
So this is anywhere in the United States. So, okay.
So yes.
There's caveats.
I was going to say,
yes,
there are some state law things to take into consideration.
Depends, right?
Yeah.
They have to be the beneficiary for at least 15 years. So you can't just go set this up and change a beneficiary.
Okay.
But generally, there's much more flexibility now due to Secure Act 2.0.
Yep. Yeah, and kind of on that note, because you asked the question. So I'm going to pick on our friends in Minnesota.
Okay.
So, yes, federally that is permissible. However, in Minnesota, if you look at the way the 529 credits actually work over on there, basically you have two different options. Either you take a standard credit or you take they call it a reduction, but it's a tax deduction off of the income tax return for contributions that you make within the plan up to a certain amount of limit. In Minnesota, if you do not use that for higher education, and I'm not even talking like K through 12, I'm talking higher education meaning college, and or like certain other schools and of higher education purposes, they have a credit clawback or that deduction clawback, so that even if you were to do this rollover, they actually recapture any of those credits that have been paid over that period of time.
But that would just be at a state level.
But that's at a state level.
Minimal.
It is minimal
Totally
at that
minimal.
point. Now, that being said, it does go over on there that you want to make sure that you understand what the nuances for that individual state where you are living. Now, you can get around that by simply not utilizing like a Minnesota plan or something like that, if that's what you're wanting to do. You just don't get the state benefits at that point. But that's a state law that is driven by we want state benefits to remain over within the state.
One of the things you want to do is obviously teach your children well, and Jonas, that comes with this whole thing because depending on what you use, they may come into financial ownership of this instrument at 18 and 21 where they may or may not be well qualified to utilize it.
Yeah, I started. There's a Unified Trust to Minors Act and the Unified Gift to Minors Act, which you set these up if you want to save money along or invest money along with your kids. I set one up for our 17-year-old, and Yeah, I think it's a great way. It's just another way to save money. You can invest it however you want to. One of the things about these UTMAs and UGMAs, and I'll probably kick it over to the guys here, that do the kids come to control these assets when they're at the age of majority for both of the UTMAs and the UGMAs?
Short answer, yes. Long answer, kind of.
All right. Well, I want to know. I just started, I just wanted to start something for Addison. And I think that this is a great way. You get around the whole, again, we were a little late in the game starting a college plan. So this was a alternative for the Everett family to kind of back up the truck, as you might love to hear, Doug, and start stockpiling some money towards college or a new house or what have you. So the UTMAs and the UGMAs.
Yeah, they are an option. To your point, I mean, one of the things that people generally aren't appreciative about that is loss of control of assets at those, whatever age it is. And again, that's state-based. So again, take, for example, I think Wyoming is like you can actually leave it inside those accounts to like age 30 or something like that. But again, it's a state-based account or a state-based law as far as the funds actually being, leaving the parent or the grandparent unit or whoever it is that's doing that gifting and putting them into the name of the kid. It's just that the kid gets some additional assistance from whoever that custodian is until they are deemed age of majority and they are able to handle the investment over on their own. But no, to your point, I mean, the great thing about them is that flexibility. There is not a, maybe pay some capital gains tax or something like that upon liquidation, but there's no restrictions as far as what those funds are actually being utilized for. So whether it's a first car, first business, or going to college, or first home, or any of these myriad of other things that people have a tendency to spend money on, especially early on in their life, right? They need to go get dishes. Well, you can do that out of an UTMA account. Might be a little bit of a stretch to say that with a 529, you call that as a qualified education expense. But you need towels and dishes. By golly, the UTMA actually is available for that.
As long as it doesn't go to Netflix.
Yeah, right? Exactly. I'm Doug Wagner, Casey Mushrush, Jonas Everett. Roger Abel, a question for you. Laura and I were having cocktails with some friends, and the issue of trust came up. Does trust have a place in this conversation where you're talking about gifting the money to grandchildren at some point?
Could. Depends how much control you want.
Okay.
I mean, if you want to have some control from the grave, you might use some type of a trust. And it depends on, what your net worth is, and a lot of different factors go into what type of a trust you'd potentially do. I don't think we see a lot of grandparents setting up trusts to transfer assets to grandkids. They might have a trust, but it's not, hey, I'm going to gift X amount of dollars to the grandkid today.
Skip a generation.
Yeah. Correct.
Well, and it's interesting that you say that, skip a generation, because just be cognizant of generation skipping tax.
Oh, okay.
So now, realistically, I mean, we're talking like $6 million, somewhere over in that range where, either would be an exemption as far as that side. But, we do want to make sure that if we are setting up some sort of a control from the grave trust, or if we're setting up some sort of an irrevocable trust or something like that, there is the potential for some additional tax, and it's just make sure that you understand what that looks like.
If you're working with a professional wealth management firm, they're going to be taking a look at your estate planning documents and making sure that everything that you're considering dovetails with what they say and your ultimate goal is as well. So make sure you're working with not only a financial professional, but a tax professional as well. Premier Investments in Wealth Management named to Forbes 2025 Best in State Wealth Management Team. Go to premieriwm.com. If you've got a question about anything, they've got a huge section of FAQs. They've got a lot of downloadable content there as well. You can find out if you're on track for retirement just by clicking Get Started. Answer a few questions. They'll provide for you a one-page Premier Vision document and an opportunity to sit down with one of my friends from Premier Investments in Wealth Management. You will get to take that document with you and sort of go over it, peruse it, because it's a big decision. They know that. That's why they're here, though, because they want to help you make the best decisions for you at Premier Investments in Wealth Management. Again, premieriwm.com, or you can call 800-383-6590. All right. Let's see. I'm going to send it over to Roger with this one. Will is asking, I had a side business to make some extra cash, but now that I have kids and a family, I want to redirect where I spend my free time. Recently, I sold my business for a decent amount of money, nothing crazy, but still six figures. Now have a lump sum sitting in cash. How do I invest this without feeling like I'm making a huge mistake if the market drops next week? The big V word, volatility, steps in, Roger.
First, I'd direct you to a previous podcast where the information, I think we have a guide out there called How to Invest at All-Time Market Highs. I think that's really good read because this misconception that the market goes down in the first week, that's a bad thing. There's a lot of evidence that actually would show you that investing at an all-time market high is actually better returns over 1, 3, 5, and 10 years than trying to be a dip buyer. In fact, you outperform normally 10 to 20%. On average. But that said, we would want to start with a plan and figure out how much of this money needs to be invested. And then ultimately, how much risk do we need to apply to this investment dollars and make sure, one, that you have your emergency fund, make sure, what your goals are for this money. He didn't really say if this is for retirement.
Right. So
I don't know. Maybe it's for a vacation house. Maybe it's for another business. So there's more information to get here. But regardless of whether you're buying a vacation house, another business, college, it all starts with some type of a basic plan to give some direction to these dollars.
Well, and kind of to carry on that, right? When we say some sort of a basic plan, it doesn't necessarily have to be this long drawn out, super large thing, right? It could simply be you have written down on a paper that I've got I've got $50,000 that I'm going to be purchasing X, Y, and Z in 6 months, and I've got this other $50,000 that I'm allocating over to this other thing. That's the very basic part of a financial plan, or really kind of that first step.
One of the things too, Jonas, is that this person obviously says I've got maybe a side business, so you would think that there's a lot of planning behind it, but maybe in getting that side business going, he had to sort of loot and pillage everything that he had in savings in order to get it together so that he could put this business together. Now that he's sold it for what says six figures, I think that I know where you're going with the very first thing. Do a financial plan and make sure there's plenty of spare tires.
Yeah, definitely. And I think it's going to give Will some control. First off, congratulations. I mean, he said six figures, no big deal. I think that's a pretty big deal. And congratulations for being able to have the control to sell it and spend time with your family. But I think that if you look at the emergency fund in general, if you have 3 to 6 months, that means that you can, if you get sick, you can take a few days off, but you might, be a little bit nervous about losing your job. If you have 180 days in an emergency fund, that means that you can tell your boss to buzz off, basically, if you need to, and look for a different job. So that's the control in the emergency fund. And again, Doug, like you mentioned, it goes back to a financial plan. And he might have some debts, like you alluded to. He might have some debts starting that business that we need to address and pick away at too, depending on what the interest rate of the debt is.
It's sort of like what Casey was talking about a little bit earlier about that skeleton of a plan, Roger. It's something that you talk about, your premier bucket strategy, to make sure that they have an idea. And that's really the way that you handle that skeleton plan, is the bucket strategy. Every bit of money has its own job.
Yeah, if someone invests money in for the reason of making more money, that's not a real reason. Right. That's arbitrary because we don't know what the goal is for it. So the first thing is it retirement dollars? Is it some other goal? You have to set a goal. Once we have a goal, that will establish the time horizon, which many times will determine where it's located, what type of account it goes into, what type of investment we use. Because if you tell us the time horizon is 12 months, well, clearly we don't want to roll the dice for 12 months. If you tell us 12 years, then you can have more risk on that. That would be in our growth bucket in that bucket strategy. And, a lot of times I think we default to the bucket strategy just for retirement distributions. It can apply to a lot of different things, right? Hey, I'm buying a lake house in 6 years. Right. Okay, great. Well, we have to have some money for growth. We need it to grow. But what if the right place comes for sale in 4? We might need to have a little bit of other money on the side just in case we need to get a quicker down payment. So there's a lot of different ways that you can, utilize a bucket strategy in your overall planning, not just for retirement income.
Casey, this is something too where what you all are saying is see this whole thing sort of come to light in front of us. And you need not only sort of something that's tax advantaged, but you need to be able to and should be considering things that are not necessarily tax advantaged as well in order to make sure that you have the right mix of investments.
Right. Well, I mean, now when we say tax advantage, what do we mean by that? Like simply a retirement account, or do we mean a non-retirement account that we are putting a tax management overlay on in order to reduce our tax liability over a multi-year time frame? So tax advantages can also be run even in accounts that aren't necessarily quote unquote traditionally what is known as tax advantaged, or like a qualified retirement account. We can have tax aware stuff where we're kicking off tax exempt interest, so we're not paying federal income tax on things like that. We can be making sure that any dividends or any other income that's coming in there are qualified dividends or long-term capital gains rate rather than having to pay ordinary income on those. So that the taxes can be an important piece. Now, that kind of does bring up another thing that I'm a little bit curious on this. We don't necessarily know exactly, just based off how the question is phrased, how recent this happened. If this is something that happened in April, have we had a tax payment yet? So was there a taxable gain on the sale of that business? And if so, okay, yes, I understand we're over six figures, but maybe by the time we back out the tax liability that's going to be coming due, maybe it's not quite so flush in terms of that cash as what the actual expectation was.
Well, it kind of goes back to something we typically talk to people about when they come into a large chunk of money. Let's just call this a large chunk, since we don't really know whether it's a divorce, a death, an inheritance, selling a business. Take a little bit of time to breathe. You don't have to do anything today. If you don't do anything for 6 months and just let it percolate a little bit, a lot of times your goals become a lot more clear. If he just sold this business, he's probably a euphoric guy. He's really proud of what he's done, but he also may have the feeling, I need to get it back to work. You don't have to get it back to work yet. You should put it in a safe spot that earns good interest. Don't leave it in your checking account.
Yeah.
But sometimes just let it percolate and really figure out what you want to do with the money.
I'm going to throw this one out here because it's sort of woven in here, but it's not part of the text that we're reading, is that small business owner. How often do you run into small business owners that go in with the greatest of intentions, and then they go in and something happens and they sell, and then they've got everything happening all at once, and then they look back in the rearview mirror and they had little, if any, tax planning, they had little, if any, record keeping, and they're just going, oh, Lord, what do I do now?
Well, here's why it happens. Typically, small business owners sell when an event happens, and it's more of a forced sale versus a planned sale, right? If you think about a planned sale, that's planned 5, maybe 10 years in advance, saying, how do I exit this business in the most appropriate way possible? But most small business owners sell, they get sick, become disabled. There's an event that happens that's making them sell. And very rarely do I see a small business owner that just says, hey, I'm 55, I'm selling. They like their business. That's why they started it.
Right.
They're making good money. The value they get for selling, they could just work 2 or 3 years longer and make the same amount of money. So typically what you're referring to, Doug, would be more of not an emergency, but definitely like, hey, something happened. I need to sell the business in the next 12 months. So they don't have the ability to plan.
Right. And they're scrambling from that.
One of the things, we work with LPL and they talk with their advisors, hey, 10 years out, start putting a plan together. Like if you think you're going to retire at 62, doesn't mean you have to, but start working at it at 52 so that it's not just, well, I want to sell today, because if that happens, alluding to your point, there's no tax planning. You're probably getting the lowest value for your business versus the most. So I think that's a good point, but very rarely do I see someone who chose to sell at 55 out of pure choice, not an event that's not organized.
Right. It's sort of like the people that they say, oh, I'm going to retire at 67, 68, and they end up retiring at 62, 63, 64 because they have to, because of a health reason. It's the same thing.
That's a really good point, because I think of 35% of the people say they're going to work till 70 or never retire, which is your typical business person, right? I'm going to work forever. If you own a business, you're like, I'm going to work forever.
Yeah.
Well, that's not reality. Timeline gets moved up. Well, if you plan on working forever, that means you did
no planning.
So that, we've talked about before, Doug, just age of financial independence.
Yeah.
So if you're a small business owner and you own a business and you're telling yourself, I'm never going to retire, that's awesome. But pick an age where you want to be financially independent and you could sell the business for the maximum amount possible because you plan for 5 or 7 years. Doesn't mean you have to. Just think about it. If you said, hey, at 62, I want to sell the business, even if you don't plan on it, and you start at 55, your outcome is going to be better. Your business will probably be better too, because you have to look at the numbers, you have to look at your margins, you have to cut your expenses because you're trying to maximize value.
To your point, you're paying attention.
You're paying attention.
Right? You're paying attention to it.
I love that, Roger, because you're talking about an illusion that I think we all have as small business owners, that we're going to work forever. And we had another podcast that basically you're not going to work forever. It's going to be 3 things. There's going to be 3 off ramps that you're going to take. You're going to retire earlier than you expected. You're going to retire on time, or you're going to work longer than you expected. There's no forever.
Well,
there's no such thing. It's just an illusion.
Here's the ironic thing. If you plan, let's say you gave yourself those 3 options. So retire at 62, 65, or forever, right? Which we know doesn't exist, but as long as you can. If you planned on retiring, you just said, hey, my financial plan, my business plan, everything revolves around 62.
Right.
And you decide to go till 74, isn't it just better?
Right.
Yeah, I think it'd probably work
it's just
out.
better.
Right?
Yeah.
But most people don't think that way. Hey, I'm going to work forever. Then, oh my gosh, 62, something happened. I need to sell the business. I'm hurt. I can't work anymore. Or, my kids aren't going to come into the business. And now I got to figure something out. Cause I think for a lot of people, well, my kids will come take the business over and that'll allow me to work forever. Yeah. Very few kids come into a family business.
And the question is, are they purchasing it? Is it being given away? And there's a lot of succession planning items at that point in time that have to be worked through
for sure.
too.
So I guess the message to business owners,
Yeah.
pick a date that you want to be able to sell it for the maximum amount. That's earlier than you think you'll retire. And if you work longer, you put a little bit of extra work in up front. I mean, it's not going to be the end of the world. It's probably going to be a better outcome for you.
And make sure you're working with a financial professional and a tax professional as well, because these things can get really complicated. You don't need to do that. If you're a business owner, whether it's a small business or a mid-size, even a large business, if you are involved in business, then you want to concentrate on that. Let somebody else concentrate on these things in the background, and they'll just take your ideas and make sure that they can put them together in a way that can benefit you financially in the future. Premier Investments and Wealth Management at premieriwm.com. Click Get Started, answer a few questions. You'll be provided a 1-page Premier Vision document that you can keep. They'll also give you a free consultation. You can sit down and talk with one of my friends from Premier Investments and Wealth Management, find out, kick the tires a little bit, see if you're ready to get started with your financial future and your retirement. Premier Investments and Wealth Management named a Forbes 2025 Best in State Wealth Management Team. Call 800-383-6590 or schedule your appointment online at premieriwm.com. Wrapping up the program with Dr. Casey Mushrush.
Just you, Doug.
Jen asks, my husband wants to retire early, but most of our savings are in pre-tax accounts. How do we access those funds without getting hit with penalties or a big tax bill?
Jen, this is a phenomenal question. And this is something that we do not see infrequently, where I've been saving really diligently. Everything went into the pre-tax 401k, and now I'm ready to retire. And so we've got lots of money that we can do it. Oh, wait a minute. I'm 55 years old and I can't pull that money until age 59 and a half without avoiding any 10% early distribution penalty. Now, fortunately, really the answer on that is just make sure you understand the various different withdrawal options and the laws that are and the rules that are surrounding those. So typically, if you're pulling money out of a pre-tax account, whether it's traditional IRA, 401k, or even like a Roth IRA or a Roth 401k, there is a 10% early distribution penalties that might be applied to those funds. And then if you're in those pre-tax accounts on top of your ordinary income tax rate. There are a couple of exceptions to that rule. So the first one is 72T, substantially equal periodic payment distributions. And simply all that means is you turn on an income stream for a minimum period of time, either a minimum of 5 years or to age 59 and a half, whichever is longer. And then you take a series of distributions that substantially equal payments over that period of time. So if you start at age 52, you have to go to 59 and a half. If you start at age 58, then you have to go all the way up to age 63. There's a couple of different methods in terms of calculating those payments, whether you're using an RMD method or an amortization payment method. There's a couple different ways you can do that. But once those are started, they cannot be turned off.
Jonas, it's also critical because this is complicated stuff. 72T, this is literally the first time in the 15 plus years of doing this with you guys, the first time I've heard Rule 72T.
You haven't been listening, Doug.
Yeah, I was going to say, we've talked about it.
You haven't been listening.
We usually call it something. I think we call it something else.
I hear 72, I think the fridge automatically. But let's talk a little bit about this because the importance of having a financial professional to help you work your way into your retirement through the liquidization of your investments in a proper way rather than in a haphazard or chaotic way.
Well, this is very popular. You have a lot of people that have pre-tax money in 401ks. I had lunch with my best childhood friend growing up, and he basically said the same thing. I want to retire early. I have a couple $100,000, and I want to get into it. And my knees are bad. I'm going to retire, and I'm like, not so fast. We need to see if the math pencils out, because I happen to know that his wife makes double the money that he ever made. And so there's just so many things going into it. But really, in a nutshell, you have to draw a little diagram, draw a circle with a line through it. And every household, you have money that's never been taxed before and money that has been taxed before. And that's where you start with a financial plan. And, it gets into basically seeing if the math pencils out. And I had to tell my buddy, there's no possible way. You just can't do it. And that was on a napkin at the cafe. But, we do a little bit better job than that for most people. So
here's what's ironic about this question. We just talked about the expectation of how long people are going to work and that most people retire earlier. If you look at the expectation of when we're going to retire, almost nobody says before age 60. Mm-hmm. Although I think it's like 15 to 18% of the people retire age 60 or before. Mm-hmm. And I think many people, as they start getting through their career and getting closer to retirement, and they start engaging with financial professionals, because let's be honest, most 30-year-olds are doing this themselves. You hit 50, you're like, well, better get serious, might need a financial professional in my corner. We're able to bring up these ideas and show them mathematically, like Jonas said, how the numbers pencil out. You could access your 401k, or maybe you have a rule of 55 available in your 401k that allows you to take funds after age 55 from your employer without any penalty, without setting up equal and periodic payments. Mm-hmm. And that's one of the things that we bring to the table. I think I said it on maybe a month or two ago, really what the financial advisors do for people. We're trying to point out the things that are in plain sight that you just haven't seen yet.
Right.
Like if you look at a picture, we all view a picture differently, right? There's things in that picture that I see that someone else doesn't, and vice versa. And that's what advisors are there to do. Pick out the little fine lines that other people don't know exist or haven't seen yet.
Casey, give me 1 minute on insurance as it comes to this, because they need to talk about this because you're younger than retirement age. So you've got Medicare as well as beyond. Before then to start thinking about.
Right. So, healthcare costs are definitely a big piece of it. So in a pre-retirement situation before Medicare age, we're probably looking at something like an ACA or a healthcare.gov exchange plan. Maybe there's some COBRA over off that side. Maybe you're one of those lucky people that actually has an early employer-sponsored plan, but you definitely want to make sure that that is a consideration, that cost, that outflow is still being taken into account as far as developing that income plan.
And all in all, Jonas, it's important to make sure you're working with a financial professional and a tax professional so you can maximize your efficiency.
Yeah. How much of this conversation did we talk about investments or products?
Zero.
Well, returns are the same everywhere.
Yeah.
If you buy ABC mutual fund from broker A and ABC mutual fund from broker B, it's the exact same return. Mm-hmm. So it's kind of secondary to putting together a really good plan and goals for your money long term.
You know what? You work hard for your money. We just got done celebrating Labor Day weekend here this last week. It's important for you to get an understanding, sit down with people who really care about what your goals are as much as you do. At Premier Investments in Wealth Management, you are going to find that the professionals, they've been in your shoes, and you know what? They understand the questions that you have, and they've anticipated a lot of them, but they're not immune to hearing the new questions that you have or the concerns that you have that they might not have known about from other people. PremierIWM.com. Click on Get Started. Just answer a few questions. They'll provide a one-page Premier Vision document to you that you can use as your initial roadmap, and you can work your way toward retirement, because odds are you don't know if you're ready for retirement. PremierIWM.com. Get started, or you can call for your appointment, 800-383-6590. Premier Investments in Wealth Management named to Forbes 2025 Best in State Wealth Management Team. For Roger Abel, the Big Kahuna, for Jonas Everett, and for Dr. Casey Mushrush.
Just you, Doug.
I'm Doug Wagner. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific, individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research.